All right, we've got about 4 minutes to go until the March jobs report. Economists expecting 60,000 jobs created, with the unemployment rate holding steady at 4.4%. Now, futures are lower ahead of that number, but we only have futures trading until 9:15 a.m. Eastern time. Markets are closed today for Good Friday. Still, we are going to get this key piece of economic data. I want to bring in former Trump economic advisor Steve Moore, Piper Sandler chief global economist Nancy Lazar, former White House counsel for economic advisors acting chair Tomas Philipson, and Job Creators Network CEO Alfredo Ortiz. Also with me, John Lonsky and Mohammed Al-Arian. Good morning to all of you. It's great to have you here. And Steve Moore, to you first. What a day this is going to be with so much happening around the world and, of course, with the U.S. economy. We've got a jobs report. What are you looking for?
Well, look, the most important thing that's happened in the labor force over the last year, I was just looking at the numbers, we've had almost no labor force growth over the last 12 months. And that's a problem, because for an economy to grow, you need productivity, but you need additional workers in the labor force. So we need to find ways to push more people into the workforce. The other thing to pay attention to is, look, there's no question that a higher oil price will lead to higher inflation. And so the question is whether people's the wages that we see, and that will be announced just in a few minutes, whether those are going to be keeping pace with the higher inflation we're seeing because of higher oil prices.
Yeah, average hourly earnings, the estimate is 0.3%, year over year 3.7%. So we'll see. We're looking for a loss, by the way, of 5,000 jobs in manufacturing. Nancy Lazar, obviously, there's going to be. Are you concerned about any noise in this report? I mean, we had the fall off a month ago, but again, we're expecting 60,000. We did have better than expected ADP this week, Nancy. We also had better than expected initial claims yesterday. So.
Well, there's always going to be noise in the payroll employment report. Not only are we going to see the, the March reading, but we're going to get revisions to the past months. And that's the big problem I have with payroll in general. I think you nailed it when you mentioned unemployment claims. Claims are the most reliable employment economic indicator, I would believe. Claims indeed were very low. They're approaching 200,000. They've been in a declining trend for 2 months. That basically means companies aren't firing anybody. That's an important set of confidence from businesses, which is that they have enough confidence in the economic outlook and that they don't, as of now, obviously need to fire people. And actually, it does imply that employment is increasing. In addition, the unemployment rate, I totally agree with, is an important metric to be watching. It's a pretty reliable indicator also, along with claims. And then third, I do like the household employment data. That is a part of that unemployment rate. Household employment has been a much more reliable economic indicator coming out of turning points, and it's actually been in a rising trend going into this turmoil, actually rising for about 6 months. So what claims and the household employment report tell me is that business confidence has indeed been improving, which survey data do indeed indicate. So we had a pretty strong backbone going into the turmoil, and that's really important because it means, and I agree with the sentiment, that the U.S. economy is in much better position, but not just because we're energy independent, but because we were clearly seeing this strength in business confidence that's related to both lagged effects of both monetary and fiscal support for economic activity.
Yeah, well, John Lonsky, from the economic standpoint, you've said this before, that, everything that we're seeing, that the economy really is on fairly strong footing. All this talk about AI replacing jobs, we haven't had that materialize yet, and some say that we're not going to see that materialize this year.
Yeah, I think a lot of what's going on with AI has more to do with the fact that companies earlier overhired when they were told that we were going to have these long-lived shortages of labor, and now they're correcting for that excess hiring spree that they had. It's not so much AI. If AI does anything to the labor market, it should make workers more productive over time. And what's important going forward is that we have a labor force that knows how to get the most out of AI. There is going to be a learning curve.
Look at the futures jump, and it is because this is one heck of a report, folks. Wow is right, Steve Moore. Non-farm jobs coming in 178 178,000 jobs. The expectation was 60,000, folks. The unemployment rate went down to 4.3%. The expectation was 4.4%. We didn't get a loss in manufacturing jobs. We got a hit of 15,000 manufacturing jobs. Private sector jobs, get this, folks, 186,000. 186,000. The estimate was for 70,000, and the average work week 34.2 hours. That was actually a little bit less than expected. And again, looking at the U6 underemployment rate, that was coming in at 8%. I'm going to go into the report, folks, as I do every month, and I'm going to give you a sense of where the jobs are. But as I'm doing that, I want to go over to Steve Moore. You had the same reaction I did. What a number! Wow.
Wow, what a great Easter weekend present this is. I mean, my God, this is way, way higher than even the range of forecasts. I can't quite figure it out. I have to look deeper into these numbers, but it is really good news for the economy. I think one of the things this tells us is that employers believe that the situation in the Middle East is temporary, and they're planning for the future, and they're hiring workers according to this report. And so it appears that employers and businesses believe that Trump is right, that we'll get the Straits of Hormuz open, that this is a temporary shock to the economy, and that we've got sort of smooth sailing ahead. And by the way, the fact that, again, we're seeing more private sector employment and a fall in the government employment is a very positive thing. It's been a trend we've seen so far. I didn't see what happened with the I'd love to see what happened with the wage rate, but overall, wow, this is an amazing report.
The government jobs was a loss of 8,000. I want to bring that up to everybody's attention, and also I'm in the report now to kind of see what they're saying as far as where these jobs were. Really quick, just to give everybody the earnings data for month and year over year, we came in average earnings month to month was a gain of 0.2%. The street was looking for a gain of 0.3%. And then as far as earnings year over year, 3.5%, which is less than expected. We were looking for 3.7%. I also want to say, and Tomas Phillips, and I do want to bring you into this, that the president actually was just posting on True Social moments ago about the Strait of Hormuz. Tomas talking about that, if we easily, and we can, open the strait, take the oil, make a fortune, it's a gusher for the world. That just moments ago from the president. But Tomas, your reaction to what you're seeing in these numbers?
Yeah, I mean, I think I'm very curious what happened to February as well, because this looks like February was just weather and strikes, which people kind of were speculating. In addition, also I'm concerned with February because of the BLS data. You never know, even when data is out, what's going on until the revisions come, essentially. So I think it would be. I'm very curious what happened last month, because we had a very strong January, right? So this is enormously strong.
I've actually got the revisions.
If last month was a blip.
Yeah, Tomas, let me give those to you because I usually do this with Maria as well. So February, we had a loss of 41,000 jobs. So we really didn't see a big change for the February number because, remember, we had gotten a loss. Actually, I'm sorry, I take that back. We did see a big change. We had 92,000 jobs lost for February. My apologies. The revision is now a loss of 41,000 jobs. So the February number got cut in half. Nancy Lazar got cut in half, and then January was revised to 34,000. So net 7,000 fewer jobs created than expected between the 2 months. But again, Nancy, that was a big revision for the month of February.
So it's one of the reasons why payroll is not the key number in this particular report, the fact that the unemployment rate went down to 4.3%. In addition, as I mentioned, the household employment report, I'm looking at that data right now. That was a little softer in March, but employment has been an improving trend. And I would go back to what I mentioned earlier, which was both monetary and fiscal support. In particular, on the fiscal side, the full CapEx expensing is lowering corporate cash payments, corporate tax payments, and that is also another incentive for businesses to actually hire, to reinvest in their business. And if you reinvest in your business, not only do you pay lower taxes, you are incrementally also going to improve your productivity and your profitability, and that gives companies the ability to hire. So I would go back to the unemployment claims data. That doesn't see the big revisions that the payroll employment data do, and they've been in a clear declining trend for the past 6 months, reflecting both the fiscal support for the economy and also the Fed has already cut rates 175 basis points. It takes roughly 12 to 36 months for changes in Fed funds to work their way into the economy. So we're still in the sweet spot of that, also to boosting economic activity. And so even though bond yields have ticked up a little bit recently, bond yields have actually been flat for the past 3 years. I know if you're a bond trader, you don't feel that way. But as an economist, when I take a step back, you've been in a narrow trading band for the 10-year yield now for 3 years. So interest rates are still supportive. Fiscal policy is still supportive. And it's not just full capex depreciation. Obviously, it's also deregulation, which is a huge support for small businesses, where a lot of this job creation comes from. And then last, also these tax refunds are timely. To be sure, they could be used to pay higher gasoline prices, but at least we have it. And that is also a buffer for consumers as we deal with these higher energy prices.
Yeah, and John's also watching the yields, and I want to get to that in a second. But Alfredo Ortiz, I want to read this to you because I was digging into the report about where the job creation was. The government is citing, Alfredo, healthcare, construction, transportation and warehousing, and then they also talk about the fact that federal jobs, government jobs, have continued to decline. Alfredo.
Yeah, absolutely. I mean, overall, Cheryl, I mean, I think small businesses actually continue to be the engine of growth for the economy. Remember that 2/3 of new job growth is actually in the hands of small businesses, and they're feeling pretty bullish about the economy overall. Look, the gas, the spike in gas prices and energy prices, I think they realize, shall I say, is transitory. And they know that that's going to go away hopefully soon with the resolution of the Iran conflict. But overall, they're feeling great. They have major provisions from the One Big Beautiful Bill that they're benefiting from this year. They've gone back and invested. If you look just at the ADP report, just as to provide a little bit of insight into where that is in terms of jobs specifically for small businesses, those businesses with 20 employees or less, they grew about 112,000 jobs. And I love seeing the federal numbers continue to decline. I just wish that the state and local government numbers would continue to decline along with it, because they seem to be shifting from federal over more to state and local governments. But we need to see those numbers come down. But private businesses continue to grow, and small businesses, again, continue to be the engine of growth. And the dirty jobs, and specifically, like you've mentioned, actually, those continue to grow. HVAC technicians, electricians, plumbers, high demand. If you look at a Randstad report recently that was just put out, double-digit growth in all of these areas.
Interesting. Well, I have made the case before to Maria that, what I've seen with the fact that you have these losses in government jobs month over month is that you're seeing those jobs shift over to the private sector. And this was a very strong private number. ADP was better than expected on Wednesday, and then the private sector jobs today was 186,000. I do want to point our viewers' attention, though, to Dow Futures. Again, market is closed today, so we'll see what happens on Monday. But we had initially a jump, John Lonsky, in Dow Futures. Now we're down 119. Is this the bond market reaction, and does this have anything to do, John, with the revisions that we got?
I think you're exactly right, Cheryl. We've, in response to this report, we see the economy may be doing better than expected. And of course, that further reduces the likelihood of any rate cut by the Federal Reserve anytime soon. And because of this reduced outlook for the bond market, the fact that we may be looking at somewhat higher fixed-term borrowing costs for mortgages and the like, the equity market has moved lower. The equity market thinks that perhaps the U.S. economy needs more support from the bond market in the way of lower yields, lower fixed-rate borrowing costs. Higher interest rates don't do anything to help with the problems we now face in terms of private credit.
What do you make that? Steve Moore, weigh in on that and what John is saying in particular about how the Fed handles this going forward, because, you know, that is a solid point, that if you had seen a weaker jobs report instead of a blowout jobs report like we just got, then you would have the Fed in a better position to maybe cut rates. And that seems to be pulling back and being taken more off the table.
It's a tough decision the Fed has to face because, you know, we are going to see probably 3.5% to 4% inflation when those numbers come out in March because of the jump of the oil price, which last time I checked was about $105 to $110 a barrel. That causes inflation. There's just absolutely no question about it. So that puts the Fed in a kind of quandary. On the one hand, you know, Trump wants lower rates to stimulate the economy. On the other hand, you know, if you've got inflation rising, maybe now is not the right time. But I want to go back, as I looked at the fine print of some of these numbers. This is a great headline number, no question about it. I think we all agree on that. But again, going back to the fact that we have two surveys here, and the household survey showed something that I talked about earlier, which is that the labor force is not growing. As I read it, and I think I'm right about this, somebody might want to double check, that there was about a 300,000 reduction in the number of people in the labor force. That's a bad number. We want more workers. Now, one thing that we need to do, now that Trump has secured the border, he gets an A+ for that, we need legal immigrants. We need more legal immigrants. As baby boomers retire, we need more workers in this country. The good news is, by the way, that AI is going to replace a lot of these jobs with robots and computers.
Yeah, Tomas, weigh in on that.
Yeah, I mean, we do need more workers as people go into retirement. The key here to the last year, and actually this year as well, is that a part of the big growth in jobs is healthcare. It's an enormous part. It's 2/3 of jobs in 2025 and even more now. And we keep talking about manufacturing, et cetera, but we live in a service economy. It's 80% of GDP that's services, and healthcare is the biggest service sector in our economy. But healthcare can't carry this alone, essentially. It's going on, essentially, because aging is taking place. And there's a lot fewer people to take care of, a lot sicker people when the age distribution shifts to the right, essentially. But that's a driver. And if it wasn't for healthcare, we would have job losses to last year, essentially, as opposed to being flat. So I'm worried about that. I don't know how much healthcare was today. I know it was expected to be the majority of jobs again this month, but I don't know. I haven't seen the fine print.
No, it was, and that's what the government cited in particular was healthcare. But I agree, you know, that maybe, and Alfredo, you can weigh in on this, that maybe healthcare can't be the engine that drives the job market, that there's got to be other factors. I mean, the one piece of good news I will say is we're not seeing that AI job destruction that keeps getting predicted. But I'm sorry, Nancy Lazar, let me bring you in on this.
So I hear you on the healthcare, but what's encouraging in this report, and it was echoed earlier this week with the ISM and in construction spending in general, we are getting goods-producing jobs back. So what excites me about going forward is that we're going to get more blue-collar jobs, which we have needed more because obviously we have a very, very diverse population and not everybody wants to go to college, can go to college. And so we need these trade jobs and they are coming back. You're seeing that obviously in manufacturing again this month. We saw it, as I mentioned, in the ISM. We're not only building data centers, we're also building new factories. And so that's going to be positive for construction jobs. So no question, up until more recently, the labor market's been lopsided toward the service sector, but that's where we've been. The question is, where are we going? And I think we are going to see more and more of these goods producing jobs, which, by the way, are good paying jobs. And so I'm excited about, Stephen mentions the weakness in the labor force participation. I've been watching the prime age labor force participation. And so what you've seen is as you're starting to see more sectors of the job market increase employment, you are seeing the prime age labor force participation grind higher. I did not see what it did in the March report, but it's been in a rising trend. It is historically high. So no question we may have an issue with overall labor force, but prime age is encouragingly been on a rising trend because we are broadening out the labor market. So I would say focus a little bit more on goods producing jobs, construction and manufacturing. And also in this report, we saw an increase in temp employment. And that is such a reliable kind of good coincident indicator that companies initially, as they get more optimistic, hired people in the temp area. And so that also is in a rising trend. So I would look at this report as the glass is half full.
Okay, well, no, and I'm glad that you said that. And by the way, I can answer your question, Nancy. 61.9 was labor force participation, so that number did come in. You know, again, it's a stronger number. Alfredo, weigh in on this.
Yeah, Cheryl, it's interesting. There's actually a lot of conversation and some analyses that are actually pointing to the fact that are we reaching a country that, you know, full employment, right? And how many jobs are actually needed, basically, to keep unemployment relatively steady? I think the Kansas City Fed issued a study that basically said those numbers of jobs that we think are needed to keep unemployment rate relatively steady has fallen from 150,000 to 50,000. So I think as AI has actually taken over in terms of a tool of productivity, especially among small businesses, I'll tell you, Cheryl, that I just came from a conference of over 1,000 folks at a large state chamber conference, and there were medium, small businesses, large businesses there. But I will tell you, overall, AI, first of all, in the workplace was the #1 conversation piece. Right. And all the small businesses there, they talk about it as the great equalizer overall.
Right, right. I'm sorry, Nancy, did you want to get back in?
Yeah, I just wanted to highlight that I totally agree how important it is for small businesses to be a driver of employment. The NFIB data does show profits for small businesses is improving, and that's going to be the next major leg supporting overall job growth. Second, the weakness in government. I agree with the point that the weakness in government is fantastic. That is the least productive side of the economy. And so what's so stunning is you have had a very sharp drop in government employment, not just this month, but over 135 federal government jobs, I believe, have declined over the past year. And those people we're moving into the private sector, and they're much more productive jobs. So I think AI is indeed a huge support for corporate profits, and therefore it is a huge support for jobs. We always have creative destruction when it comes to new technologies. We had that with computers in the 80s, we had that with the internet in the 90s, and we're going to get it again with AI. But the United States is incredibly flexible, allowing this destruction, unlike many of our European counterparts or other parts of the world where it's very difficult to, this is a horrible word, but to fire people to utilize new technologies where we do, and that boosts productivity and that boosts living standards and is good news for the consumer, not bad news.
Nancy, I'm so glad you said that because I agree with you wholeheartedly. I've said that to Marie as well, that I believe that AI is not going to be this destructive force. It's actually going to be a tool, and it's really going to help job creation, help companies become more productive. When you have Walmart that says, you know, we're going to, cut some back-end jobs, back in the store, but we're going to hire in the front of the store because AI is making us more efficient. I think that that's such a great thing for American companies like Walmart. Mohammed, I do want to get kind of your broader, macro take on all of this, and where do you think we go from here? What's most important to you as we move into the next week?
So my 4 summary takeaways are: 1, this is great news for Main Street. We have an economy that's creating jobs. It's led by the private sector. And yes, we do have a labor participation issue, but our economy is dynamic. 2, we have this contrast that Steve spoke about between a very resilient real economy and increasing inflationary pressures. And at some point, we're going to ask the question, is this a stable mix or is this an unstable mix? So keep an eye on that. 3rd, this is not good news for Wall Street. It is pushing up borrowing costs at a time when borrowing costs are already harming mortgages. And we are seeing quite a few of the lower quality companies having refinancing issues. And finally, to link back to private credit, it is also not a good news for private credit, because the last thing you want is a credit issue in addition to a liquidity issue. And that puts the Fed in a really difficult position, as Steve rightly said. And this notion that we are in a good place with monetary policy, they've got to revisit this. They've got to take an approach like the ECB, like the Bank of England, to be much more intellectually agile in thinking about how this economy is evolving.
Steve Moore.
So, Cheryl, can I add something to that, Cheryl?
Of course, yeah.
Yeah, just 2 quick points. Number one, when you were talking about the construction jobs and unions, the one area where we're seeing a lot of growth in construction, you know what it is? It's building data centers. And the irony is there's this kind of revolt around the country against data centers when, in fact, they're huge job creators. And a lot of the unions are saying, hey, we want the data centers. And Bernie Sanders is out there saying we don't want them. We don't want artificial intelligence. The other point I want to make, and I think Mohammed is right about this, if we get that oil price back down to $60, we are going to see the biggest economic boom we ever saw in this country. It so much depends on bringing the oil price down, getting the straits open. Trump said he's going to get this done in the next few weeks. I'm here to tell you, if that happens, the economy, U.S. economy, is primed for a big boom.
I'm so glad that you brought that up, Steve, because President Trump has been busy in the last half an hour or so on Truth Social, and he did post about the Strait of Hormuz. And I want to show our viewers this post. I mentioned it earlier, but I want to kind of read you the full context of what the president is saying about the Strait of Hormuz. And this means that this is where his mind is right now. With a little more time, we can easily open the Hormuz Strait, take the oil, and make a fortune. It would be a gusher for the world, with some question marks there. President Donald J. Trump. Nancy, weigh in on this, because, again, from a global economic, perspective, we've had, concerns about, a global recession. Obviously, we're going to see inflation numbers that are going to be hot because of what we're seeing in the energy sector, Nancy. But at the same time, the president continues to say, when the Strait is open, as he just did, when this conflict is over, which he has repeated, that means that the story will change.
So first, energy is not inflation. It is a one-time shift up in price. It is a tax on the system. I would also argue, as were the tariffs a year ago. So what you're going to see is, as oil prices go up, and I certainly hope they do come down sooner rather than later, is that you're going to see downward pressure on other prices. Net, yes, inflation, as it's reported, is going to accelerate. But I think it's really, really important. This is not the 70s, where we had egregious monetary fiscal policy supporting OPEC, supporting higher prices. We've had much more responsible monetary and fiscal policy. You don't have rapid money growth. You don't have rapid government spending growth. Net, so this is a tax on the system. Certainly the Fed should not react to it. Obviously, by raising rates. I was in Europe last week. That they are talking about raising rates in Europe. I think that is a mistake, because this is not inflation. It is a one-time price shock. In addition, I disagree that the Fed needs to cut rates. Why are we getting these stronger numbers? Let's take a step back. And it's not just this particular number. There's been a batch of economic data that been on the stronger side. Retail sales, the ISM, construction spending, overall construction spending driven by factories and data centers. And at the end of the day, why is that happening? Well, because the Fed has already cut rates 175 basis points. And so I think the economy is actually in a good position. I agree, near term, we could have a growth scare if prices of oil stay about go to 150 and stay there as we move into the back half of the year. But as of now, it looks like 1Q GDP could still be about 3%. I was getting ready to raise our GDP forecast to 4%, and then the war happened. Obviously, I'm not going to do that. But would we be willing to do that? I agree. As we can move out of this tension, we will be most likely revising up our forecast. So, no, I think the economy is in a good spot. The data show it, not just today, but over the past several weeks. And watch unemployment claims going forward. It's weekly data. It's reliable data. And they tell you business confidence is actually pretty elevated.
Yeah, and it was better than expected yesterday when those numbers crossed, and then we had better than expected ADP, Nancy. So absolutely, and I love the 3% growth for a quarter where we've had all this global upheaval. I think that's a very bullish sign from you. John Losky, you wanted to get in?
Well, the only problem I have with that assessment is that the consumer and the voter doesn't necessarily agree. My goodness, I mean, the biggest issue facing the Republicans in the November midterms is the economy. They think the economy's underperforming. And I think this also goes beyond just inflation. I think there's a lot of younger workers that are dissatisfied with the job opportunities that are available. Consumer sentiment is at a recessionary low. We're not in a recession, but my goodness, it's ridiculously low, as is consumer confidence, given that we have almost a record low unemployment rate. So putting this together, the bigger picture tells tells me Americans are not totally happy. And I want to toss out a question. I can't really answer it myself, but, you know, we're now at the first anniversary of reciprocal tariffs, their introduction. And I'm wondering whether or not the overall economy was made better off, worse off, or the same because of the introduction of tariffs. I can't help but think myself that globalization is actually a good thing for the young people, for a lot of workers in this economy, whereas this movement towards a more isolationist economic policy would prove to be a bad thing.
I think Steve Moore's a good person to answer that.
Well, it's a tough question, John, because on the one hand, I always tell the president, you know, I'm not a big fan of tariffs. But, John, I do like some of these trade deals that Trump has come up with that has really gotten concessions from other countries to try to create a more level playing field and hopefully bring tariffs down. I guess on balance, since I'm not a tariff guy, I'd say they've probably been negative. The big issue, by the way, as you all know, is what's going to happen, Cheryl, with these what's the number, $150 billion or something of refunds and rebates that are going to be coming to American companies. We'll see the impact of that. I don't know if that might be inflationary or not, but that's a big number, Cheryl, $150 billion.
Well, I think it's going to take some time. I think that the courts are going to have a lot to say about that, and I don't think that's going to be anything instantaneous, to be clear. I think it's going to take...
Well, by the way, they've already, a lot of these companies are already suing to get the money, and so, you know, there are going to be a lot of lawsuits, but at some point, I mean, the court has basically said that if the tariffs were illegal, the money has to be returned. And it seems pretty clear about that.
I will say the Treasury Secretary has told Marie that there are other avenues. Those avenues are being pursued.
I can pipe in on globalization.
So, yeah, there you go. Exactly, Nancy. Go ahead.
So globalization, I think, is overrated. I call this globalization 2.0, bringing manufacturing jobs back to the United States. And this actually started 15 years ago. This is not something that the tariffs engineered. I would agree with Steve that I'm not a particular fan of tariffs. It tends to be a regressive tax on U.S. consumers. But bringing manufacturing jobs to the United States is, again, good news for middle America, good news for blue-collar jobs, good news for increasing labor force participation. So to the extent to which that's happening, so globalization 1.0 gouged out middle America. Those jobs went to China. I've been a huge advocate for that for over 15 years. And I think again, this did not start with tariffs. This started in 2010 and has been going on with goods-producing jobs rising. So globalization 2.0 is good news, is because those jobs are starting to come back to the United States. And I feel badly for Europe because they are not going back to Europe. Again, the European economy, I think, as you keep mentioning the global backdrop, and the United States really is a standout. Europe is losing jobs in the manufacturing space, and that is a very, very sad state longer term for their economic health.
Mohammed, weigh into this as well. I have a dearth of economists this morning. It's great. Mohammed, go ahead.
So I'm not as optimistic as Nancy is on globalization 2.0. Globalization 2.0 is somewhere between managed globalization light and fragmentation. And we really need to stick to managed globalization light. Light means we don't hollow out various sectors. Manage means we control choke points. Because if we go to fragmentation, then these choke points are going to prove really problematic. Yes, of course, the U.S. is better off than Europe. We're a more closed economy. We're a more self-sufficient economy. But we are still dependent somewhat on the rest of the world. So I would be careful that we don't slip into fragmentation as a reaction to the failures of globalization 1.0. We've got to get to manage globalization light in order to reduce our own vulnerabilities.
Well, it has been quite a panel. We have no lack of news breaking this morning after this incredible jobs report. Dow futures down 120, but they're going to stop trading at 9:15. What a power panel. Thank you so much, everyone, for being with me today. I've got some other things I want to get to here, but John Lonsky, thank you so much for being with me. Mohammed El-Arian. Steve Moore, it's always a pleasure. Always love our time together on the jobs report. Nancy Lazar, an absolute pleasure. Thank you for being here. Tomas Philipson and Alfredo Ortiz. Thank you so much to all of you.